first stage of home buying process is figuring out your budget. You might think that you can already estimate how much you can afford, but that might not be the reality. Therefore, it's a really good idea to sit down with a mortgage specialist and learn about your options. Today I have Mustafa with me, who is a mortgage specialist with RBC Royal Bank. So Mustafa, what is a mortgage anyway?
Mortgage is actually a loan you acquire from the bank to complete your purchase of your condo or a house.
Can anyone get a mortgage?
Yes and no, because there are different programs most of the major banks have. So depending on your case, you can qualify for a certain program, you cannot qualify, but there are criteria most of our banks look at.
Tell us about the options in getting a mortgage.
When it comes to getting a mortgage, you have two options. It's based on the down payment. You have high ratio, which is basically the minimum in Canada is 5%. So up to 5 to 20% we call the high ratio. This is where the bank needs a default insurer to insure your mortgage because you're borrowing more than 80% of the property value. So in these cases, we actually send your application to default insurer. They take a look at it and there will be a fee for it, which usually gets added into your mortgage.
So tell us about the criteria the banks are looking at when someone applies for a mortgage.
There are certain criteria. It starts with the down payment first. The first question the bank will ask you is what you're willing to buy and how much down payment you're going to go. That's the first option. They will look at your down payment, how much you're going to put. The second thing is we'll look at your credit bureau, which is basically, there are two companies in Canada, one is TransUnion and one is Equifax. We look at your credit history to see what your point is.
Okay, great. So you told us about the credit score. So how can the home buyers learn about their credit score and what are the ways to improve it?
There are a couple of ways you can look at it. You can either go through TransUnion or Equifax and ask to receive your score. Or actually, if you're a client of RBC Royal Bank, you can actually go to your online banking and you can learn your score. Let's say your score is low. What are you going to do? Credit is all about usage and you have to demonstrate that you can handle credit. Sometimes we have clients which they have no bad experience, but they just never use credit because they always use their debit card. But credit system doesn't work like that. They want to see how you can handle credit. So I'm not encouraging people to get into debt, but you should demonstrate that you can handle. So if you think you can pay it within the month, use your visa as much as possible, and before the end it comes, just pay it off so that way you don't pay any interest. But that way, even though you paid it, even let's say you use it and the same night you pay, you practically actually borrow money from the institution and you pay back. So doing that helps the credit score a lot.
So we've been hearing about the mortgage rules change for quite a while. So what are the rules these days?
Well, rules are unfortunately a little bit harder right now. Regardless of the down payment you put, now the rule is 4 times of your income. This doesn't mean that you won't qualify because there are client-specific programs like Newcomers to Canada where we don't really look at your income. I'll get into it in detail, but there are programs like that.
So tell us about the down payment rules.
Well, in Canada now, we used to do zero down payment mortgages with 40 years amortization. That was 2007, and then the government changed the rules. Now, if you want to buy, you need at least 5% of the down payment of the purchase. And if you are buying anything more than $500,000, the bank requires 10% on anything more than $500,000. So let's say you need $550,000, 5% for the first $500,000. Anything more than $500,000 will be 10%.
So as we all know, Toronto is getting a lot of immigration. So what are the options for newcomers to Canada?
For newcomers, you have two options. It depends on your current status here. So let's say you're a PR, permanent resident. You just got your PR, and as long as you're within your first 5 years, which is a very distinct program compared to other banks, RBC will still actually consider you as a newcomer. So if you have the 25% down payment plus 1 year worth of mortgage payments in your account on this, you won't look at your income, we'll just look at your down payment because obviously 35% is a lot. So that's one option. But what if you're not, let's say you're on work permit? We have a program where we will look at your income. You don't have the 35% down, but we have the regular program. So we'll treat you like a regular Canadian. We'll look at your income and you can qualify for that. That's for people on work permit. But what if you're a student or international investor? For those, we have programs for that specific to the countries. But there's a program very close to the newcomers to Canada where you have to come up with at least 35% down. So for foreign investors, that's a really good program. So we, again, disregard your income and we'll look based on the down payment you're bringing.
We've been talking about seeing a mortgage specialist before actually starting looking for a house. But what is the pre-approval process really?
Pre-approval is basically a simulation we will run. It's a really good way to see how much you can afford, because you don't want to go into the market without a pre-approval and then find a place you like and then realizing you cannot afford and you're going to end up with a heartbreak. So we always tell our clients to get a pre-approval because you're going to run a simulation on a price range of what you're comfortable with. Look at your credit score, and we'll even cap your rate. So we will actually book your rate for the next 120 days. Let's say you don't buy within that time frame, we'll do another renewal and we can always renew.
Can you tell us about the mortgage rate these days?
Definitely. So you have two types of mortgages. You have variable mortgages and you have fixed mortgages. Variable is always based on the prime. Prime is the lending rate of the bank. So you have a rate and the term is only 5 years. So you have a 5-year variable closed mortgage where basically your rate will be same as long as prime is same. But you will have basically a prime minus, let's say prime minus 0.4. Today the prime is 3.45, your rate will be minus 0.4%, so it's 3.05. But if the prime goes up, your rate will go up. Your payment doesn't change, but the amount which goes into principal will go down. Or if the prime goes down, that's even better for you, then you will pay more principal. That's variable. It's only 5 years. And fixed is a little bit different. Fixed, you have more options. You have 1, 2, 3, 4, 5, 7, or even 10 years. But usually Canadians, we go with 1 to 5 years. Fixed, the good thing is the rate is guaranteed for the term. So you don't have to worry about where the prime goes. You're guaranteed for the term. You have more options and you're guaranteed. So that's the one thing. So the bank gives you a lot of provisions to make additional payments to your mortgage so you can make it faster. Because mortgages you can go up to 30 years, but you don't have to actually pay your mortgage within 30 years. You have 3 options usually with mortgages. You can pay 10% of your anniversary amount, which is, let's say you start with a mortgage with a $500,000, you can put every single year $50,000 anytime during the year, and that payment will go straight to principal. That's one option. The second one is you can increase your mortgage payments by 10% each year. Let's say you're paying $2,000 a month, next year you can make it $2,200, and anything you put extra will go straight to principal. This is not only one, there's also something called double up. The minimum is $100 to a maximum equal to your mortgage amount. So for example, your payment is $2,000 a month, you can do on the side that $2,000 payment minimum of $100 to a maximum of $2,000, meaning you can literally pay double every single month if you have the money, obviously. So these ways you can actually finish a mortgage. If you, let's say, a 25-year-old mortgage, if you use all this provision at the same time, which you can finish your mortgage in 6 years. And your mortgage would naturally end. There's no penalty cost.
Okay, thank you very much, Mustafa, for the valuable information that you shared with us today. So like Mustafa said, it's really a good idea to sit down with a mortgage specialist before actually asking your realtor to look for a home for you. If you have any question about mortgages, you can always reach out to Mustafa and he can answer all your questions for you. Until next time, thank you very much.